So what happens when the US market goes down? What is the portfolio in total going to do? How's it going to behave? Well, 2/3 of the time, there wasn't a huge difference between the two portfolios. And a huge difference I count as 1% or more, 100 bips, right? But 1/3 of the time, there was a difference of more than 1% between how the two portfolios performed, right? So 1% on a $1 million portfolio, that's $10,000 more money you would have, on average, for holding US government bonds. Now, the worse the market drawdown got, the better US government debt did. So when the when US stocks went down, you really wanted to be holding US government debt because they simply did better. And if you guys jump to the next scatter plot page, you'll see there's a relationship between the severity of the drawdown and the degree to which US government debt outperformed US corporate bond performance. So now to do a little summary of risk return. So again, it looks like just by adding 2% more equity to a portfolio holding US government debt, we're going to get pretty similar pre-tax performance. Now, once we start applying taxes, it's going to make a stronger and stronger case for US government debt. And then the next page, you can actually see the different tax brackets across states at the 4% level. And the takeaway is that you don't really have to earn a ton of money to hit the 4% state income tax bracket across the US. Right? And again, to touch on earlier, in summary, for drawdown performance, the worse a market drawdown is, the more you really want to be holding US government debt because it's going to increasingly outperform US corporate debt. Now let's figure out what does all this mean? How can investors take this information? What can we do with it? Well, one thing I want to caution is that this is what has happened in the past. This is past performance. So the relationship between US government bonds and US stocks and how US government bonds either hold their value or tend to appreciate, tend to increase in value when US stocks go down, will that continue in the future? Completely unknowable, right? So that's one thing you have to think about. The reason being is that the relationships that investments have to each other, that does change over time. You can even look at how US government debt and US stocks, their relationship changes over time. Now, a lot of the time it is negative, right? One is going to go up when the other goes down. That's not always the case. And then who asked the duration question about interest? Okay, perfect. So now we have a strong case for using US government debt exclusively over corporates. But what about interest rate risk, right? This is literally on everyone's mind right now. Interest rates are going to go up, my bonds are going to lose their value, et cetera, et cetera. And because US government debt pays a smaller coupon, has a smaller interest rate than corporate debt, right? It's going to have a longer duration. And a duration is a function of interest rate risk. So all else being equal, two bonds, and one has greater duration than the other, that's going to be more subject to interest rate risk. So I took a look at a roughly 5-year US Treasury bond and a similar trade, roughly 5-year bond by Microsoft, right? Very highly rated company. And I said, okay, here's what it's worth today. What happens if interest rates move by 1%? And the difference in value of how one changes to the other is down to single-digit basis points. And as you increase taxes, it actually makes a stronger case for government bonds because government bonds actually lose less value post-tax given a high enough tax bracket with respect to interest rate changes.